And just over 30 minutes ago, the Bureau of Labor Statistics released the February jobs report, giving investors a fresh glimpse of the U.S. economy. And here's what we learned. The U.S. economy lost 92,000 jobs last month. That is below economist estimates of 50,000. Additionally, the unemployment rate rose steady to 4.4%. And here to break down that data and so much more is Ben Emons. He is the founder and CIO of FedWatch Advisors. Ben, welcome to NYSE Live.
Good morning, Nashi. Good to see you.
So they expected to add 50,000 jobs and they lost 92. What do you make of this report?
There were a few things going on here. There was a big strike at Kaiser Permanente that was counted in that number, and then there was some seasonal effects, and the BLS always has challenged with the statistics, so they made some changes to a particular model, how they count for new business employment and business going out of business, and then account for that unemployment too. And I think all of that coming together dragged the headline number just down, but it's always a surprise. Like, I had myself forecast of 85,000 based on real-time indicators, which are all good indicators, and yet this payroll report comes out really differently. So sometimes it occurs that we have a survey period, which is the time when they collect the data, that certain specific things happen there, like in this case a strike or weather or whatsoever, and just throws off the entire calculation. So is it a bad number? It's not a good number, obviously. There's a lot of losses across the board. But I wouldn't read into this like, whoa, okay, we're going to see more negative numbers from here, because we actually still have a pretty good labor market at this moment. Given the jobless claims number, unemployment rate didn't go up too much. It's like a tenth, which is not significant. So I think it was just a headline drag here at this moment.
How does the BLS collect this data?
So they use what they call a survey, where they send out 3 times a month to a actually small sample size. I think it's like 2,000 people or businesses. You know, how many people they've hired or laid off and that sort of thing, and essentially collect from there what the payroll data would be looking like, which is a small subset actually what actually is happening, but that's the way it's done. And then you have 2 other surveys. You have the household survey and the establishment survey. One counts for 2 jobs and the other one for 1. Forgot which one. But either way, they merged those 2 together and then put that in that survey period, which is about 2 weeks, 2.5 weeks that they collect that data. And it turns out that not everybody responds to that data either, by the way. So they're getting typically about 40% of the actual respondents basically telling the BLS, yes, I hired people, I laid off people, and that's how it works.
All right, and February 2026 ADP data was released on Wednesday. It showed that U.S. private employers added 63,000 jobs. How heavily is this report weighted versus the jobs report that we received this morning from the BLS?
Well, ADP has become more important. You know, that's actually the true payroll data. It's people on the payrolls, whereas the non-farm payrolls accounts for essentially the entire labor force, if you think of it that way. So the non-farm payroll report has more fluctuation than ADP, but people have been looking at ADP saying this is a quite consistent report now because of methodology. So I think either way's strong, but this report is the bellwether. You know, whatever happens with this, whether it's strong or weak, it drives the market actually, and we can tell that the markets are reacting negatively to this report.
And do either of these reports have a strong bearing on the Fed's interest rate decisions? Like, how heavily do they factor them in? Do they look at private jobs data?
They do. I think they've gotten far more sophisticated over the years to look at other alternative data as well to gauge what the payroll data really are, what the labor market really is doing. The Chicago Fed has now a real-time dashboard of the unemployment rate and hiring and layoff data, which they track across all kinds of industries and doing their own surveys. And it just showed that it's been quite steady labor market. So this is an outlier report in this way. But in the end of the day, the unemployment rate in particular, how it's calculated by the BLS, that's the official statistic that the Fed does follow. I mean, there's not an alternative unemployment rate that they would accept as an input to monetary policy.
And let's shift to oil prices in the Middle East. We've seen oil prices surge since the conflict broke out. How much can oil prices spike if the Strait of Hormuz blockade continues?
I think a lot. It's already are up like almost $20 now from Sunday's level when we finished something like $67 $67 on Brent, and we're at 89 now, so $22. So it's a huge move, and it's in line with previous sort of oil price spikes that we've had in the past, whether it was in the 70s or 80s or 90s. You know, that can have a big impact on our economy at some point. The gas prices is already coming through pretty quick because Brent is the contract for our gas prices. And then interest rates have reacted to this movement in oil prices going higher. So the mortgage rates will be resetting higher really quickly now too. So that both of that puts pressure on the economy quite quickly. We transmit that really fast.
And could the war have an impact on Fed rate decisions moving forward?
Initially, they may look at this a little bit through it, saying like, you know, again, you're getting a shock. Let's see how it plays out, sort of language. But then the history, though, has shown that the Fed tends to look at what's the ultimate impact on employment. And the history of it is not good because whenever oil prices go up 20, 30, 40%, the unemployment rate goes up too. And that's what they will react to. There's some extreme studies on this, but I saw this morning, like, if the oil price goes up, say, by 100%, the unemployment rate could go up by 1.5%. That would be really significant change from the current situation. I do think the Fed will react to that quite aggressively.
And Ben, there's so many different storylines. We have the conflict in Iran, we have the jobs report, inflation, the Fed. How are all of these things connected?
They are very interconnected because, you know, as you sort of outlined, like, we had this AI story, we had the economy doing well, we got the, you know, the big beautiful bill, we got now this war coming in. So this is sort of like giving us a mix of an economy it could get hit by this conflict, by the way, more significantly, I think. It's definitely maybe coming through the next number of weeks. Against the backdrop of having all the stimulus coming in too, we have investments coming in, we got spending, and then the uncertainty about how AI exactly affects the economy through higher productivity and perhaps maybe more unemployment, yes or no. And then the tariffs are on top of this too, right? We have the new tariffs now potentially put in place as of next week, a 15% global tariff. So I think you're getting a very uncertain situation. The business uncertainty will rise again. Consumer sentiment will get worse. And it will not only be politically an issue, but it will be economically an issue. So I think the next few weeks, our data will change a lot.
And in our last minute together, we've seen Treasury yields go up. And I understand you say it's not only inflation, but perhaps strong data that's causing the bump?
Yeah, that was interesting this week that the ISM data that came out on Monday and Wednesday were more stronger than expected. And on both occasions, the 10-year yield went up with something like 3, 4, 5 basis points, something in that range. So I calculated from the weekly change in the 10-year yield, more than half of it can be explained by that strong data, which does still say that if the economy holds up through all of this, rates should go a little bit higher. It makes sense. If inflation becomes an issue, which it could be, and I think this is what yields are responding to as well, the Fed cannot cut rates. In fact, all the rate cut expectations will be rolled back, and the Fed will become more, what we say, hawkish in its language to make sure that the expectations don't get out of control, because they will react to what happens with gas prices in particular. And I think this is a worry in the Fed. The more gas prices go up, the more consumers expect future inflation to go higher as well, and that's troublesome.
All right, Ben Emons, founder and CIO at FedWatch Advisors. Thank you so much for joining us on NYSE Live.
You're welcome, Ashley. Thank you for having me.
Thank you for being here.